The Fed will set policy later after a jump in energy prices has complicated the inflation picture. Crude oil is hovering at around $75.50 a barrel after jumping past 76 in Asian trading earlier, as reports suggested President Trump is considering his options in the Middle East, which could include joining Israeli airstrikes on Iran. That comes as Fed policymakers will set rates later against an already tricky backdrop of inflation risks. Christopher Rossbach is co-founder and CIO of J Stern. Christopher, do you think we've already seen the market price in the implications of a wider conflict, or should investors expect oil could go much higher?
I think we're facing an exceptionally difficult geopolitical and macroeconomic backdrop where the underlying economy has been strong, but we're waiting to see the impact of the tariffs on costs and on spending. The conflict in the Middle East has already been reflected in oil prices. The signs were that there was a lot of supply and that oil prices were going to come down. So I think a lot is priced in, but clearly if there is a significant disruption in terms of supply, either because of the closing of the straits or because of some kind of an attack on actual oil production, there could be a spike. If fundamentals prevail, I think a lot is already priced in.
Americans are famously sensitive, though, to pump prices. So do you think this complicates the picture for the Fed?
The Fed looks at core inflation, and we've seen mixed signals for that. Again, underlying economy strong, underlying spending so far strong. Some of the most recent indicators on spending, on restaurants, for example, purchases looking a bit weaker. So the picture looks really quite balanced. And I think with the risks of the conflict escalating and the impact that that could have on confidence and on spending, I think it's much more likely the Fed will be cautious and continue its pause than to take any kind of action or to take a strong signal at this point that they're looking to change the rates either way.
Of course, as you say, the markets are not expecting the Fed to move rates today, but we do get a new dot plot, a new set of economic projections from Fed officials. What will you be listening out for?
The key thing is, again, this balance between the strong underlying picture, between the inflationary pressures that have come from the increase in tariffs, which are going to have an impact over the next quarters, the possible impact of the higher oil prices, but then offset by the natural corollary, which is the decline in spending. And both corporates have been holding back and consumers clearly have started to be more cautious. So I think that the picture continues to be balanced. The question will be how the Fed will be interpreting that and whether they're going to be sending new signals. I think with the backdrop that we have, this balanced picture, the famous Goldilocks, I think is more likely than not to prevail.
As you say, economists are still waiting for the impact of tariffs to really feed into US consumer prices. When are you expecting that to hit the economy?
The actual impact is going to be felt now that we're rolling off the inventory that has been bought. We've seen indications that companies have imported goods where they've been able to beat the tariffs, and now the rollout is going to come. So I think it's through the summer months and then into the end of the year that we're going to see what's going to happen. But it's also going to be offset and impacted by what actually happens with tariffs, because at the end of the day, many of them have been paused into the beginning of July, and companies have been trying to navigate around that. If the tariffs continue at the current levels or continue to be paused, I think there'll be one impact, and I think it'll be much more moderate and may already have been priced in. If we go into another bout of trade negotiations and escalations, the situation could be different and the impact could be much greater.
How long do you think the market might be waiting for a Fed cut, or do you think the situation's too uncertain to make a prediction?
I think it's very difficult to make a prediction at this point. I think the good news is the Fed has a lot of tools. We've been in environments where we've had deflation. We've been in environments where the Fed has effectively used all the tools at its disposal. And we're now at a point where the underlying economy has been strong and where the Fed has basically all tools that it can use, starting with communication, which is what they're doing now, including the rate cuts that they did just to signal that they're ready to act to support the economy if necessary. And so I think the good news is the Fed has a lot of tools which it can impact the economy. And I think Jay Powell is right to be cautious, to be data-driven, and to await the impact both of what happens in politics as well as what the impact is going to be on the economy before taking action. So while I think it's hard to say if there will be rate cuts, I think the Fed has a lot of tools to support the economy if we are looking at a slowdown.
That was Christopher Rossbach of J Stern. Don't forget, you can watch more videos on Reuters.com.